I started an investment in Spotify in December 2022, and I bought it at $78, and it's up 231%, but it's like 1% of my portfolio. And so if I've been smart, I would have made a full-size bet of 10%. And I saw what they were doing in the podcasting space, and I only invested very little. So I kind of feel that was a mistake, even though you could say I made a profit. And so this is something I struggle with because I feel I had the same conviction in Spotify as I had whenever I was building a position in Alibaba. But one worked out and the other one didn't.
Today, we're going to be going over your portfolio because you recently did a portfolio review as you just hit the 10-year mark of tracking your performance. And this actually was put together because of what we've been doing in the TIP Mastermind Community. We've had our co-host Kyle Grieve share his portfolio reviews, and those have been some of just the really most popular calls we've had more broadly. And I figured that the audience would love to hear about your portfolio and how your portfolio has done over the past 10 years since you just did a review and you spent all the time entering your trades online to figure out what in the world your returns actually were. So how would we just kick it off? You could share your returns and any other comments you have related to that.
Yeah, thanks for teeing that up, Clay. So the Investors Podcast was founded in 2014. As you can tell, I'm already dodging the question, but I'll see if I can get to it at the end. But the Investors Podcast was founded in 2014, so it seemed timely in any case to review my track record and share with the audience. And so this is from January 1st, 2014, and then up till February 29 this year. And so we're recording on March 8th, in case you're like, this is a super weird time to like make a cutoff. That's because it's the most recent number by the end of the last month. And I think it's with some hesitation that I wanted to review the track record in public. And I wanted to mention why. Because let's say that I was outperforming the market. In that case, of course, it's nice. There's probably an element of vanity in case you would then disclose your track record. But I think that you also run the risk, especially if you have a bit of a public persona, to people following you into trades. And it's not like I have so much money that it completely destroys the market or anything like that. It's not like would be the case for Warren Buffett, but just more like a lot of people would perhaps follow you into different positions, especially if it's smaller positions, and they might say that they might clone you and they might get upset if something goes wrong. It could also be that you would have all kinds of biases by doing so, and you would sort of like wouldn't be able to sell it because you felt you let other people into the trade, even though with all disclaimers, don't invest in the same thing as me. And I just remember, like, back in the day, I was following so much what Warren Buffett was doing, and I was doing many of the same trades. And I wouldn't want others to feel the same way about stocks that I invested in this situation where I would potentially be outperforming the market. And then if we turn the tables and said, well, what if I didn't outperform the market and I still disclosed my track record? What would then happen? Well, in that case, your listeners might say, why am I listening to this podcast? Why don't I just buy an ETF and not listen to Stig? And who do you think he is? And really, the point of TIP or the Investors Podcast has always been to interview the best investors, to give and empower our audience, to give them the tools to make their own decisions, not to mimic what the hosts are doing, but also, come up with the right process, not necessarily more than what happened over the past 12 months. And I think that's very important. And so I wanted to just use that as a disclaimer going into it. But anyways, so my returns from January 1st, 2014 to 29th of February 2024 is 21.4% CAGR. CAGR lingo, compound annual growth rate, and this is dollar weighted. I should say. And so in comparison, and I've chosen the benchmark just to give you like a benchmark. I chose the MSCI All Countries World Index, and in the same time period, it has returned 8.9% CAGR. And it's not, whenever I say it's the All Countries World Index, it's very much market capped. So, for example, the US is 63.8%. And I used a tool called Sharesight, where you can import your trades into, and sort of like it spits out a report for you. I think we're going to talk a bit more about some of the methodology later. If some of the listeners want to like figure out what's their own track record, and perhaps they have different asset classes that's not being disclosed in their brokerage account. And I should also mention, and I don't know how nerdy everyone is about like track records, but it's the compounded method, so that's the most conservative one. And we're going to go through quite a few numbers in this episode. So what I've also done, and I'll make sure to talk about this at the very end here, I also wrote like a blog post. It's probably my first post in 5 years, something like that. And so I outlined like my portfolio, my track record per year, and then a total of that. And I'm just going to make sure to link to that in the show notes, and then everyone can just go in and read it, or not read it if they prefer not to.
So first of all, I'll say congratulations on such a wonderful result to date. 21.4% over 10 years is definitely not easy to do. And it reminds me, in the community, one of our members commented on your result, and they pulled this excerpt from Fred Martin's book. That's it talks about Benjamin Graham's investment approach and Buffett, and Buffett and Graham have both said that it's relatively easy to achieve reasonable returns from stocks, but it's very difficult to achieve returns that exceed some sort of benchmark like the MSCI World Index or the S&P 500. And he also stated that 10% of all fund managers are able to beat the market average in any given year. And when you extend it out over a 10-year time period, only 2% of fund managers are able to outperform the market. So I also appreciate that your approach has changed over the years. So I think when you were closer to my age and where I'm at in my journey, you were more focused on capital growth. And you've talked a lot about how now you're more focused on capital preservation. And many people can look at what's in someone's portfolio, or they hear the returns you get, and they look at, okay, what does he own in his portfolio? But I think to put things in perspective, I think it's also to consider the price someone pays for a position. So you can look at a lot of super investors today that have massive stakes in Apple or Microsoft or whatever else. They might have added to those positions 5 or 10 years ago when the valuations in their view was much more attractive, and they're hanging on to it from here and maybe not even adding it to it at today's prices. So holding a position and buying a position is two very different things. And I mentioned the capital preservation piece. Knowing your investment objective is also important. So your investment objective is likely different than a lot of people in the audience. And it's just two things that really matter a lot. So I think it's also important that you mentioned that we're learning alongside the audience. I think if people looked at, my day as a podcast host, it's very, very different from that of an equity analyst or portfolio manager. I spend a lot of my days preparing for interviews, editing audio, reading books, and spending a lot of time with our mastermind community. And you could argue like a lot of that does help me develop as an investor, but there's a lot of things I'm doing that, I wouldn't be doing if I were an equity analyst or portfolio manager, had the goal of achieving, or had the goal of beating the market really. And, all that time, really adds up that you're not spent analyzing companies, researching industries. And I'm here to learn, just like a lot of people in the audience, and trying to empower people rather than try and achieve the best returns possible. Although I really wouldn't complain if that ends up happening during my tenure here. And one thing I've also learned as a host is that high returns don't necessarily make a good investor. I believe it was Michael Mauboussin's very well known for distinguishing skill versus luck. And it's very difficult to do with investing. So if you look at investors that got the best returns in 2021 alone, in that year alone, they were probably taking excess risk and, investing in companies that got ahead of themselves, overinvested in future growth. And many of those investors were actually pretty lucky during that time, many could argue, and had their luck eventually turn the other direction. So when you zoom out over 10 years, how do you think about this dilemma between skill versus luck?
I definitely think that it's mainly luck. My lovely wife said to me the other day that no one can be lucky for 10 years, but I think I might be the exception to the rule. I certainly attribute most of my track record to luck. Whenever I think back on some of the decisions that I took, like some of them felt pretty marginal, and hindsight's always 2020, and I think we have a tendency to think that whenever we have something in our portfolio that works well, it's because we're really, really smart. And if something goes bad, it's because we're very unlucky. And I'm very cognizant of that potential bias to have. I certainly remember that back from my day playing poker, where if I won a pot, it's because I was brilliant. I was outthinking my opponent. If I lost, it was a bad beat, and the other guy was just super lucky. And it's not a good way of living your life. So I do think that 10 years is a relatively short period of time in the grand scheme of things. And with a high level of certainty, I expect to achieve a significantly less impressive track record over the next 10 years. I think if you put me on the spot on whether or not I could sustain like a 20% plus CAGR, those are the type of track records for the likes of Warren Buffett. That's everyone who knows me certainly knows that I'm the very opposite of him whenever it comes to skill set. So a probability would probably be like low single digits or anything like that. Like I'm not saying it's zero, but I just don't think it would be possible for me. And I should also say on that note, speaking about billionaires, I highly recommend Jeff Bezos' wonderful book, Invent and Wander. And so it's a compilation of the shareholder letters and a few other things. And I'm going to paraphrase here, but he talks about how, and this is a letter he sends to the team and shareholders, but how the Amazon team are not necessarily super smart because the stock is going up, but they're also not the opposite if the stock is going down. And so I think that's so important for us to remember as stock investors. And of course, our track record is to some extent a scorecard, but it's so volatile, and there's just so many things that's outside of our control. And just one element of luck, if I can just include that. So I've been lucky to contribute more money to my portfolio in more bullish years and contribute less in other years. And so I generally like to be fully invested whenever I can. And so there is an element of luck in whenever I was going into, say, private investments, and whenever I was going into to public investments. And then also to your point about what the financial goals are. So my financial goal have for a long time been financial independence. And now my goal is very much to preserve wealth. As much as I would like to grow wealth, I would like to preserve wealth. And so today, like for example, starting out reading all of Buffett's letters, I would never invest in gold. And now I have I think it's like a 7%-ish investment in gold, in physical gold. Because, there's a war going on 1,000 kilometers away from where I'm recording, and I never thought that would be an issue. And all of a sudden, I see good argument for holding gold. Not because I think gold is going to outperform the S&P 500. That's not why I'm holding it, but I hold it as an insurance. I also have 2 ETFs in my portfolio, and I don't think those ETFs can generate 20+% CAGR. There's no way. But that's also not the strategy right now for me. It's very much like, how can I preserve the purchasing power that I have now? And I like to think that it's a feature, not a bug, that my risk profile has changed to become more conservative. And so for all of those reasons, I would imagine that my track record is going to be significantly worse the next 10 years than the past 10 years. And then, I can draw on about some of the expectations I have to the interest rate environment, but it's sort of like a different discussion, perhaps not what you talked about.
Mm-hmm. And there's upside inherently when we're investing. We're thinking about what's the potential upside, what's the potential downside. And when you're trying to achieve financial independence, you probably care about a lot more about, asymmetric plays, high upside potential. But, when you're focusing more on capital preservation, a lot of focus is really put on that downside protection, which naturally limits the upside potential. Gold is a fantastic example where, maybe just throwing out numbers, 90 or 95% of cases, it probably underperforms the S&P 500. But, in those 5 or 10% of cases, it might do really, really well. And you look like a genius for owning gold because it just does, way better. Maybe it stays flat while the S&P drops 40%, or maybe it drops 10% when the S&P drops by more than 40%. So, it's really difficult to put to perspective, like, why you own what you own, because the world is just fundamentally uncertain and things are always changing. And I wanted to also mention Mohnish Pabrai's fund, because that is also a pretty large stake in your portfolio. So I was curious if you could share with the audience a little bit more about that.
Yeah, that's a good point. So I should probably say that there are many reasons why I wanted to invest with Mohnish, but I did consider whether or not I should include it in my portfolio. So I have different private investments. I also have public investments. I kind of felt to make a more comparable portfolio review and talk about the CAGR on that, it would have to be public listed assets. I also included gold, which definitely drawing down my returns, but I kind of felt I wanted to have gold in there, even though it's technically not listed. But I think it's a very important component of a portfolio, again, depending on your life circumstances and all that good stuff. But going back to your question about Mohnish, so this was an investment I made back in 2022. And like you mentioned, it's a sizable position of mine. And it's not a listed asset. So, but to me, it didn't feel too different than including Berkshire Hathaway. And I have 10%-ish in Berkshire Hathaway. It didn't feel too different like having Mohnish manage my assets or owning a small part of Berkshire Hathaway and have Warren Buffett manage those assets. And so I included that in my portfolio. And it's also one of many reasons why I feel that the MSCI All Country World Index sort of made more sense as a benchmark. And we're going to talk later about whether or not you should have a benchmark in the first place. But I have a lot of exposure to the US, and Mohnish has a lot of companies outside of the US, which I really like from a diversification standpoint for my own portfolio. And then, of course, there's also the inherent thing about having your own biases and being aware of your own biases. And so having someone on your team that just looks at other stocks that you do, I like that too.
Mm-hmm. And you've interviewed who knows how many people. You've been podcasting since 2014, and you've talked with a lot of fund managers. There's a lot of people you could have invested with over the years, but you chose only one fund manager at least, to invest with, not counting the Warren Buffetts of the world. So why did you choose Mohnish out of all these people you've interviewed over the past decade?
Yeah, that's a good question, Clay, and it's a combination of a lot of things. And so perhaps the most important thing is to invest with a manager with a long and successful track record. And so that you could put Mohnish into that category. I think it's also a question of understanding the process. Someone like Mohnish Pabrai, at least with the skill set that I have, that obviously is not to at the same level as his, but I want to think that I understand what he's doing, and I think it's very important to understand the process. And it's not too different than whenever you want to invest in a stock. Like, you have to understand what can potentially go wrong and whenever the bull thesis breaks. And so by having access to Mohnish and not just, on a one-to-one basis, like, say, asking me for an interview, but like being able to follow him and listening to his other interviews and like figuring out what's going on, I think I understand the process well enough to have an idea of if he would do something silly and I should stop investing with him. Whereas I think if I invested with a macro investor, like, I think macro is very interesting. I just don't know how to invest accordingly. And like, I don't think I would know, like, whenever that asset manager would potentially go off the rails, just because I don't have that skill set to be like, that's not the way it's supposed to be. So I think that we have I think Mohnish has a similar skill set in terms of like being a micro investor, understanding companies just so much better than me. But I also think that there's an element of, in the value investing community, we meet so many people who speak Buffett fluently, but few can walk the walk and they just talk the talk. And so that's also why you have to really consider the long-term record. And because we hear and we speak with all of these investors, and they talk about circle competence and having a strong moat and margin of safety. But then whenever you ask about the track record, sometimes it doesn't look good. And so it really goes back again to the track record. Then I have a criteria about investing with someone who has the vast majority of the net worth in their fund. I'm surprised to learn how rare that is. Most asset managers would not have that, which is a red flag in itself. There's a fee structure I like, the 0-6-25. So 0% fixed fee, 6% watermark, and then 25% fee for returns more than 6%. And that 6% sort of like accumulates, so it's not enough. It's good 1 year and then terrible the next year. And so I feel that very much aligns our interests. It's copied from the Buffett partnerships. And I think I've probably seen and spoke with too many asset managers where it was a pure percentage of AUM or asset under management. And if that's the case, we all react to incentives, and it would give an incentive more to become a marketing machine more than a great asset manager. I talked about before, like, how reliant I am on the US, which I absolutely love. I also think that diversification is important, and Mohnish is looking at all of those places I'm certainly not, like Turkey and India and a bunch of other countries that I would never touch, and I rely on his better judgment on those investments. And he runs a very concentrated portfolio, 10-ish positions, and lets his winners run. And I love that approach of, concentrated portfolio, let winners run. So I don't have any issues with him having, 50% in one holding if that was one of his winners. I think that's perfectly fine. I can size my own position with him accordingly if I don't feel comfortable. I wouldn't have 100% of my net worth with any asset manager, but like, I can, if I have 10% with him, and he has 50% in one stock, it's only 5% of my portfolio. And so I like that. And I should probably also say that it might sound a bit ironic, but I really like he's not available to shareholders. I think that there's something to be said about learning from the cues from Buffett and Munger, whereas like, yeah, you can do that once a year. In Mohnish's case, like there's an online event and then there's a live event at his office. But I think too many asset managers spend too much time speaking with shareholders, investors, and that they should probably spend their time focused on creating value rather. So because of all those reasons, I know that was a long spiel. I think that Mohnish just checks the boxes, and so that's I like this idea of only investing with the highest of convictions. And so because of all of that, I only want to invest with one, and in this case, it was Mohnish.
Yeah, and if I remember correctly, you invested with him in 2022, right?
Yes, from April 1st. Yes.
Okay, and taking my memory back, I believe you interviewed Mohnish right after you invested around that time, and you talked all about the process of. I believe you talked about why you ended up investing with him, and you talked about how you can think about picking a fund manager and such. So I'll be sure to link that discussion in the show notes. And one thing that stood out to me in your response there is that you said that you feel you understand what Mohnish is doing. I'd like to learn more about this because if I remember correctly, his track record goes back to around the year 2000 or so. And he's a very well-known value investor. And I think back to some of the talks he's gave 1-2 years ago, and he talks about circle the wagons, buying higher quality companies and letting your winners run. So part of me feels that his approach has maybe changed in recent years. And, part of me questions, well, is the first 20 years really that relevant if he's, changing his process and changing the type of companies he's invested in? So maybe you could talk about that and, what about it, gives you the comfort of understanding what he's doing and how he's differentiated from the others, with the exception of, diving into these very unique markets.
Yeah, I think that so we're both students of history, and if you look at the greatest companies, they change and they change with the times. And I think that's I'm going to interview actually Mohnish a few days after this is being published. So perhaps I should ask him about that. But I think you bring up a good point where you're saying, okay, so we have perhaps 20 years of you approaching things this way. Now you're doing it another way. Why would you still have the same returns? I think that's a great question. I think I want to go about this from an angle of success tends to leave clues. If you look at what Warren Buffett is doing now and what he did in the 90s, what he did in the 80s, what he did in the 50s, I think I think it's a natural evolution, but he hasn't done the same thing because he needed a new skill set. He needed to adapt to the times. He needed to adapt to how much money he was managing. And I think it's the same thing with Mohnish. Like he had to change, like we all had to change. And so I have a pretty strong conviction in that. And then at the same time, I have a part of my portfolio with Mohnish, not all of it, because I think that diversification piece is so important. Because I could be all wrong. I could be completely wrong. But then at the same time, I really like that you asked that question. One of the things I do in preparation for, I typically interview Mohnish throughout April, some point in time, and then it's getting published throughout the Berkshire weekend, and it gives me the chance to go through all the videos, which I just started today, and there are 50 videos, and they're roughly 1 hour each, so there's a lot to go through. And it's so interesting because whenever you do that and you really concentrate on that for, let's say, 3 weeks, you can almost feel that there is a progression going on throughout that year because you follow it so intently. And I've probably done that. And I know I interviewed him, like you mentioned, 2022, but I think I've done that the past 5-6 years, like that. So it's very interesting to see the investment philosophy change, but at the same time, I feel it's fundamentally the same. And so, and it's still very much micro bottom up investing.
I'm also curious to learn more about your private investments. 100% of my portfolios and things that are publicly listed, anyone can go out and buy. But private deals are quite unique because you never know some of the things that come up, or with the connections you have as a host and the types of people you get to meet and the opportunities that get brought to you. Talk more about your private investments and how this plays into the bigger picture for you.
Yeah, so I haven't included my private investments in the returns I talked about before, or in the blog post I'm going to link to. And I haven't because I felt that the results would be too extreme. For example, I have made an investment, a private investment, I think it was 2 years ago, something like that. And I got access to it, to your point, through different connections. And so whenever I signed the dotted line, I probably made 10x, so 1,000% return on that. But it was a very atypical deal, and not something that can be replicated. So if I were to include that type of return in my track record, I'm going to sound like I'm way smarter than I am, because it was such a unique situation.
How is it possible to make a 10x when you sign the dotted line? I'm sure many in the audience are going to be curious about this.
Yeah, so private deals comes with it depends, of course. But in this case, the GP really wanted me to be a part of it for promotional reasons and whatnot. And so there can be an element of a bit of sweat equity in, or it might be the case that they're giving you very favorable conditions, and then you're supposed to be an advisor, being sounding board for a few different things. And so, like, if you look at the dollar amount that's put in, it looks outrageous, probably, but it might still make sense for the other party. Not that I should compare myself to Warren Buffett by any means, but for example, whenever he did the famous Goldman Sachs deal during the Great Financial Crisis, like, the terms he got was just outrageously good, and you might be thinking that was just terrible for the shareholders of Goldman Sachs, but it really wasn't, because Warren Buffett he brought something else to the table. He brought his name, reputation, and a few dollars, and so it was a good deal for the shareholders of Goldman Sachs. And so this was not a Goldman Sachs type of deal, and I didn't contribute billions of dollars, whatever he did back then. But the principle behind being in the fortunate situation where I could put my name up and give favorable conditions. And then you have other private, I don't want to call them investments, but friends and family who might have gotten a loan at 0%. I also did not include that in the track record, and because it's not an investment, it's love money. It's because you care for your friends and family. So there are a few things outside of the portfolio that you're not seeing, and so everything else equal, if you were going to check up on that and say, oh, you have 10% or 15%, whatever it is in Berkshire Hathaway, know that these numbers are a bit skewed because they don't include the private side.
Now, in measuring returns, it sounds easy because you just look at, oh, this is where a stock was at the beginning of the year. Here's where it ended at the end of the year, and it went up 20%. That's your return. But once you start digging in and you do this over 10 years, you do various trades, you get into certain markets, and you have different accounts, it becomes very complex very quick. And then, you're buying things in the middle of the year. So, you might have bought one position in 2015. You might have added to that position 2 months ago. How does that change the returns and such? So how about you share how you use Sharesight to measure your returns?
Yeah, so this was something I've only started doing because I just looked at my brokerage account, just like I guess so many others. But of course, the problem with that is if you have other investments that's outside of that account, like it's not included. And so, like you said, it quickly became very confusing. And so, for example, for my gold holdings or pop-right funds, and like some of that would just like mess things up. And so one of the members of the TIP Mastermind Community, he was like, "Hey, dude, why don't you use Sharesight like the rest of us?" And I was like, "Oh, I never heard about that." And so I signed up, and I think I paid like $31 a month. I think there was like different savings or something like that, and we should probably set up some kind of deal with them and figure something out. But like it's not a super expensive tool, but it does cost some money. And but for me, it has been very good in terms of tracking everything and figuring everything out. Like, I don't know which broker you're using, but like I've been surprised to see how inflexible my own broker is in terms of measuring returns. And Sharesight has just, has just been created for investors and can just give you brilliant reports. And so I found that to be very good. I should say, and this might just be me, and because I live in Denmark, I have a broker in Danish. Like I couldn't auto import it, but I heard from other people way smarter than me, probably also because they use an English broker, that they can auto import everything. I had to import all of my trades manually. It took me like 4 weeks or something ridiculous like that to do that. But it was actually a lot of fun doing it. It was gruesome, but it was also fun because I had a chance to go through every single trade I made since 2014. So it was
down memory lane, right?
Trip down, painful, but a trip down memory lane, yes.
I just pulled up Sharesight's site. They have a free version. It lets you do one portfolio up to 10 holdings. And then they have 3 other levels. It's actually really accessible. So there's a starter, $7 a month, investors, $18 a month. So yeah, the audience might want to check that out if they're curious of what their returns have been. So given that you went line by line, entered every single trade, you've probably done some reflection on what you did right, what you did wrong over the years. So how about we start with some of the things you did wrong? What were some of your biggest mistakes and learnings from that?
Yeah, so I don't know how much time you have. Actually, there's so many mistakes. It was like I was going through it and I was just shaking my head so many times. Well, I think we also have to go in and define a bit what is a mistake. Like, is it in percentage? Is it in dollars? It probably both to some extent. Is it more a principle? So let me give you an example. I invested in Phillips 66, and I think this was back in 2015. And I did read the financial statements, I should say. But to be completely honest, I had so much confirmation bias, at least whenever I'm looking back, because Buffett just made a position. And so I was really looking for ways to find a good excuse to do the same thing as Buffett. And I count that as a mistake. I actually ended up making a profit, probably because Buffett is smart. I don't think I am. But I think the mistake in that was the due diligence. I feel I did the wrong due diligence, and it was more luck than anything else that made that a profitable trade. I know some studies that say that you can just buy whatever Buffett is buying and sell whenever he's selling, and of course, there's a caveat that he can do it before you know, and like it has to be disclosed 45 days later and all of that. But like, I think if you make it like a very mechanical approach, you can probably make good returns like that. I just generally don't think it's a good strategy to follow. And so, in any case, that was a one-off, but I felt it was a mistake. If you talk about dollars, and I've talked about this a few times here on the show, I definitely am not pleased with my investment in Alibaba. My cost basis is $120, and I think right now, at the time of recording, just look up here, $73. Wow, ouch. So measured in dollars, it has been my biggest mistake because I put a decent amount of conviction behind it. And one day I might start like a self-help group for all of us who invested in Alibaba, and I constantly wonder if it's a mistake still to hold on to it. It's certainly not worth what I thought it was at the time I made the investment, but I also feel it is severely undervalued at $73. But there's such a fine line between success and failure, and if we ran this scenario 1,000 times, who knows what would have happened? I certainly know that in this, I kind of feel bad about it because now I'm starting to excuse myself and say, and sort of like, oh, perhaps it's just bad luck. I don't think it was bad luck. I think it was poor judgment on my end. Full stop. So I think that there's an element of you make a mistake, perhaps, or in this case, certainly by buying into it, but it's also a potential mistake to hold on to it. Like you don't really have, like right now in a situation with Alibaba where the business is not getting that much better, are you really then just hoping for a multiple expansion because you feel it's being undervalued? Perhaps that lack of multiple expansion is justified because the business isn't getting that much better. Like it's such a tricky situation, or perhaps it's just me that's ignorant. Continuing down this painful trip down memory lane, I bought into the Stars Group back in 2018. They're most known for owning PokerStars, and they were later bought by Flower Entertainment. So I sold it at a 55% loss after a little more than 1 year. I think that was my biggest loss measured percentage. I did invest very little though, and so it didn't really have any material impact on my portfolio, but it certainly didn't feel good. And then I should say, another type of investment is not to invest with enough conviction in your best ideas. I started an investment in Spotify in December 2022, and I bought it at $78. And it's up 231% here as of today. So that's in the 15 months. But it's like 1% of my portfolio. And so if I've been smart, I would have made a full size bet of 10%. And Spotify was a stock I previously owned. It was a product I used. I saw what they were doing in the podcasting space, and I only invested very little. So I kind of feel that was a mistake, even though you could say I made a profit. And so this is something I struggle with because I feel I had the same conviction in Spotify as I had whenever I was building a position in Alibaba. But one worked out and just the other one didn't. And I think one of the reasons why I invested so little in Spotify was because I just lost my shirt investing in Alibaba. So I remember at that time feeling very vulnerable and like, Stig, your process is all wrong. You invested in this Chinese company, and even though like you had such high conviction going into that, now you have the similar conviction going into Spotify. You should probably just like dip your toes in the water, which I certainly did not do with Alibaba. And so I think that was probably one of the reasons why. And another thing, if you allow me, is that I think I've also learned that it's not a question of whether or not you're right more than 50% of the time. If you have a 10% probability of doing 100x on one of your investments, generically, I don't know if that's ever going to be the case, but like, if you have 10% probability of doing 100x, like you should be playing that game all the time. And so it's also a question of letting your winners run. And I don't always think I've done a good job of letting my winners run. And then I think the last thing I would say to this is that it was very interesting to see how many positions I had, like how many stocks, ETFs I've owned since 2014. I figured out that the answer was 45 in my case. And I currently own 5 stocks and 2 ETFs. And it really reminds me of the conversation with Ian Cassell that you did, Clay, on episode 606. And you talked about Nick and Zach from Nomad Partners, or Nomad Investment Partnerships. And, you said to Ian, well, they basically had Berkshire, Costco, and Amazon. And then he responded, well, they had to hold probably hundreds of stocks to realize that those 3 companies were the ones to hold on to. So I don't know. I just really like Ian's take on that.
I totally agree with what you said on Phillips 66. Say someone buys a stock that really doesn't align with their philosophy. It goes up 30% over 2 years, and then they sell it 30%, we'll say before tax, and then they sell it and they call it a win. But Buffett has often said his biggest mistakes were mistakes of omission. So you can look at Phillips 66 and went up 30%. Yay. You didn't lose money, but you're forgetting about all the great companies that you didn't buy, and you just missed out on 2 years of compounding within those companies. It's not to say that it was necessarily a loss to make 30%. And Chris Mayer has really helped me appreciate, having this. I just like how he just uses a 10-year view. It's somewhat conceivable. It's kind of ridiculous to say, hey, we need to have a 50-year view when we invest, but 10 years, it feels pretty doable. And, as you mentioned, I've really also come to appreciate letting your winners run and appreciating that the power of these longer term compounders, because, the power really is in the long tail of letting them compound. So if you're missing out on those first 2 years, then you're just delaying that process. And it's interesting also that you say that Alibaba was a mistake to buy, or you're contemplating whether it was a mistake to buy. And in terms of the market price declining, yes, it was a mistake if you judge it on that basis. But, in studying history, you start to really appreciate the Graham saying that the market's a voting machine in the short term, but a weighing machine in the long term. And when you look back at so many great businesses, a lot of great companies go nowhere or they decline over 2 or 3 year periods. And, the market does crazy things, and you don't know until, say, 10 years later whether the market was rational or irrational in the pricing of that asset. And we had a community spotlight yesterday with a member of our Mastermind community, and this member worked at Microsoft for 25 years, worked alongside these heavy hitters, Bill Gates and a lot of other names that people would be familiar with at Microsoft. And he joined the company in 1988. And he was just talking about how he was just all in on this company. And he told us he put 100% of his retirement money in Microsoft stock because he was just totally bought into what they were doing and their mission. And then he mentions, he joined in 1988, and over the 10 years that preceded that, the stock compounded by 40% a year. And then when you look at what happened to Microsoft stock after the tech bubble, of course, it corrected heavily. It was something like, 50% correction, something in that ballpark after 1999, 2000. And then the stock went nowhere from essentially 2001 through 2013. It's just a flat chart. Like it's not really doing much. The GFC, it obviously went down. And, obviously it's been a big winner. If you would have bought it at any point in 2001 to 2013, you would have looked dumb from 2001 to 2011. But, in the long run, the market's a weighing machine. And Alibaba is probably a pretty good case study here, because your average price, I believe you shared, was 120. Now it's trading at 73. And that doesn't mean that buying it at 120 wasn't necessarily, a bad decision. It could have been a bargain relative to the underlying value, because that's all that matters, is like, what's the value of the business and what that value will be over time. And, what we're really getting at is the world is not as black and white as we'd like it to be. There's so much gray area, and, the likes of Annie Dukes of the world have taught us that you can make a bet with a 99% chance of being right, but it not working out. You could have a hand in poker you're almost certain is going to win, but then someone flips their cards and they got a 4 of a kind, and you're like, what in the world? And it's just like, a bad beat, as you mentioned. So maybe you could speak more to Alibaba investment, and is it a mistake because the price declined, or is it a mistake because of something else you overlooked?
Yeah, so I think that there is this wonderful quote that risk is everything that's left that you haven't thought of. It goes along those lines. I think we tend to be susceptible to resulting. So we look at, in this case, Alibaba, and we say it's down, so that was a mistake. Or we invested in Microsoft that's flat for I don't know how many years, and it was a mistake. But perhaps it wasn't. I think you're too kind, I should say, though, in terms of my investment in Alibaba. I don't think I appreciated the CCP and what they did and how they... I could probably come out and say that you could only make a decision based on the information you had at that point in time. Like, let's say that you invested in airlines like Buffett did before COVID. But then second level of thinking would say, if you haven't included COVID, is that your fault or whose fault is it? Because it was something that was possible. I don't think I certainly didn't include COVID in my assessments before it happened, and I didn't include, at least not well enough, everything that was going on in China from a regulatory perspective. I didn't consider how the Chinese government would go in and restrict Alibaba's cloud product, for example. And so, was that a mistake? I think yes. I think the answer is that it was a mistake on my end. And Morgan Housel, in his wonderful book, Same as Ever, he talks about setting yourself up for success and talk about if you ran this experiment 1,000 times, you want to be in a situation where you would win the vast majority of the times. And so everyone who invested in Bitcoin, for example, depending on which side you're on, perhaps you're a genius or you feel that the people who invested in Bitcoin are degenerate gamblers. I don't know. But I don't think if you ran the scenario of Bitcoin and being all into Bitcoin 1,000 times, I don't think you would see the outcome that you're seeing now. I think you would see a lot of very bad outcomes some of those times. I don't know how many. And so back to your question, with Alibaba, if we ran that simulation 1,000 times, would it be a mistake 1,000 times? No, I don't think it would.
How do you get started with stock investing? I've put together a course to teach you everything I wish I knew when I first started investing in stocks. Let's start at the beginning and ask, what is a stock? Let's zoom on into what it's actually like to buy a stock. A few options are Charles Schwab, TD Ameritrade, Ally, E-Trade. Fortunately, you won't have to necessarily calculate all of these taxes yourself. I'll outline a few main ones to be aware of throughout your lifetime investing journey. As Warren Buffett says, your best investment is yourself. There's nothing that compares to it. By the end, you'll be savvier about stock investing and personal finance than the vast majority of people. Even if you're not a total beginner, I'm confident you'll get a lot out of the principles and strategies I outline, which we'll build on throughout. A link to the course is available in the description below. See you there.
And I think there's also another lesson here with Alibaba. I know Charlie Munger was well known for betting big on Alibaba, then doubling down. And I know there were other super investors. I don't want to name names because I'm not 100% sure of who all bought into it. But, it's a case where you can't just clone people. Cloning isn't going to have a 100% hit rate. Mohnish talked about this in your episode with him last year. Mistakes are inevitable. Even if you're a super investor, you're going to make mistakes, and you shouldn't just clone someone, especially Stig and I. Again, we aren't equity analysts or fund managers. We're just out here trying to learn and get a little bit better every day. So that's another thing, just as an outside observer of what I see in Alibaba. And tying into mistakes being inevitable, I loved that Mohnish last year on that episode, he mentioned that investing is a very forgivable endeavor. You can bat less than, he said something to the effect of, you can bat less than 50% on your investments and still come out smelling really nice. I love the way he phrased it. He just has a very funny way of putting things. And I totally agree with him. When you have this approach of, letting your big winners run, they hopefully tend to far outweigh your mistakes that, again, no investor is going to bat 100%, and mistakes are just part of the game. So certainly not trying to pick on Stig here and trying to find all of his mistakes over the past 10 years. So with that said, let's turn to your big winners over the past 10 years.
Yeah, well, thank you for also teeing me up to talk about perhaps a few. I'll be the first to say that Bitcoin has been good to me. I don't think I bring anything new to the party, and I certainly don't want to use this platform to talking about why you should be invested and not be invested in Bitcoin. And especially because of what Buffett and Munger has said, it tends to be a very toxic thing to talk about on the show, which is also why we have a different show the president is hosting when he's talking about it. Whenever I got my education and reading all of Buffett's letters and reading the Snowball and like all the 20 best-selling books on Buffett, we learned that you should invest in real companies or invest in something like a farm compared to a nugget of gold, because one generates cash flow and the other one doesn't. And I think I see that differently today. Every time I invest $1, I estimate the probability of getting more than that dollar back. How much can I gain? How much can I lose? And what's the probabilities of that? And Preston and I started covering Bitcoin back in 2015, and I started building my position in 2017. And I've been adding it to it since 2022. But I didn't want both the Bitcoin show and then We Study Billionaires to be about Bitcoin. I don't think that was the idea. But for me, it seemed to be a very asymmetric bet, like what we're looking for as investors. And a lot of people would probably, disagree with that, and I think that's perfectly fine. And we can jump to the next point. Luckily, there have been other winners, but it's not something I've invested in because I'm anti-establishment or because I think it's going to replace fiat currencies. Or I know a lot of people think that, and that, who knows, they might be right, they might be wrong. The way that I invest my money is I estimate the probabilities of upside and downside, and I could very often, and probably I am wrong, as you could tell from what we talked about before, and that was how I made the investment into Bitcoin. Nothing more, nothing less. I am mainly invested in equities, I should say. Alphabet has been good to me. I started building my position in 2018. I remember at the time. And this was bought at a split-adjusted price of $54, and it's currently trading at $135. I remember thinking Alphabet at the time was already huge, like 600 billion-ish market cap. But at the time, I've started to gain an appreciation for good businesses, and I saw no reason why it would change. I started building a position in Berkshire in 2014. At $115 for B share. It currently trades around $400. And so in percentage gain in a CAGR, it's not as impressive as, let's say, an Alphabet or something different, or Spotify for that matter, even though it's a very small part of my position. But in dollar value, since I've invested significantly more in Berkshire, it of course is a different situation. So again, it depends on, do you look at percentage or dollars? And then I would also say, in terms of winners, I'm mainly talking about the positions I hold now, but I would say that I've transitioned into what Mohnish would call growing pies instead of discounted pies. I think that a lot of value investors, they probably start with cigar butts, or perhaps it's just my own bias, but I've just heard that story so many times before. And then they transition into paying up for quality down the line. And so, which is also why I talked about before about having bought 45 different equities. But the last stock I bought was in April last year, and so I can see how I trade less and less, but also how much I focus on quality. And you can make a really good living investing in businesses and then have them appreciate whatnot up to the intrinsic value and then move on to the next stock. There's nothing wrong with that approach, and that is how a lot of value investors invest. It's just a different approach than the one I'm following now.
So regarding Bitcoin, you mentioned that you invested in it since 2022, and I just wanted to clarify. So your initial purchase was in 2017, price is up 10 or 20x now, and I believe the last time you added to it was 2022 on the weakness. Is that correct?
Yes, that's correct.
Okay. Yeah, I just wanted to clarify, just so the audience didn't think since 2022 you've just been trying to increase it ever since then. But the last time you added was in 2022 on the price weakness there. And you mentioned your approach to equities. You purchased a company in April of last year, and it was definitely a situation where we'd say you're paying up for quality and with the attempt of buying a growing pie rather than a discounted pie. So that I think that's a good transition to talk more about that and how your investment approach and how you view investing in equities has changed.
Yeah, it's kind of interesting. And again, I can only talk about my own story as a value investor. But again, I hear so many people saying that they started with cigar butts, which is ironic because if you read about Buffett, you also learn that that's not the way you're supposed to invest, and he's saying that himself. And then, at least I did, and then I made all the same mistakes as he did right out of the gates. No, like I was saying before, it can be profitable to do the approach of discounted pies, and then wait until it reaches intrinsic value, assuming that you're right, of course, and then move on to the next stock. And that was how I started it. And I think that I don't think it's a bad way to start, even though I would also encourage you to focus on quality. I don't think it's a bad way to start because you learn to be more comfortable with the quantitative piece of it. Like you learn how to focus on low multiples, which I think is important. You learn to find that margin of safety, especially whenever you don't fully understand the quality piece. And so, even though of course you can be terribly mistaken and you can fall into value traps and whatnot, if you buy cigar butts in the beginning of your career, very often you don't get burned too much. There's a lot of caveats to that, but I would probably make that argument. And so, and then I would also say that one of the mistakes I made in the early days was that I thought I felt I owned too many stocks in my portfolio. And I think you also have to consider a lot of things whenever you consider how many stocks to own. Whenever you're young, it's a diversification in itself. And so if you have no money or not a lot of money, if you own 2 to 4 stocks, that's perfectly fine. If you lose it, you'll have plenty of time to get started once again. And the other thing is that if you feel you're just starting out, you have $10,000, whatever, and you feel I really need to be diversified, and then you want to find 15 stocks. If you're very new and you want to be invested in 15 stocks, you're probably forcing the action. And I'm going to make the claim that if you find that many stocks, you probably don't know them well enough to be invested in the first place. And so, so how do we find them? Well, either, like mentioned, you don't understand them, or you didn't buy them at the right price because you said to yourself, I have to have this number of stocks, otherwise I'm not diversified. Whereas perhaps at that point in time in your career, you should probably be thinking, well, I'm like doubling my portfolio from the inflow of capital from my day job on an annual basis, so I don't really need to be as diversified as I would think. And so, I think if you're just getting started in investing, one way you can slowly go into picking individual stocks would be to buy like a world ETF from Vanguard, whatnot, and then every time you find a stock, then ask yourself, is this better than what I already own? And through that, gradually, cautiously start to invest in individual stocks.
What's somewhat impressive to me when I look at what you own is how few positions you hold. I mean, when you're looking at the individual pieces, you now own a couple ETFs and invest with Mohnish. That adds to the diversification. And when I look back at my journey over the past couple of years, I've added heavily to a handful of companies over the past year or so, and did something similar to what you said, where I'm transitioning out of these maybe safer plays, things that I know are likely to work well over a long time, like an index fund. And I often think about which companies I might not own in 5 or 10 years. I think it's pretty foolish to think that, as we're all trying to be long-term investors, but it's pretty foolish to think that my portfolio will have the same holdings 5 or 10 years from today, just due to things changing as fast as ever. And it's really difficult for great companies to keep doing what they're doing for a long time. And, I'd like to also think that I'd be willing to part ways with a company that, where the thesis just isn't there anymore and things have changed and it's time to move on. So with that said, I'm curious if you have any best love ideas you'd be interested in sharing that you've been forced one way or another to part ways with.
Yeah, I used to own Process, and the company is probably mainly known for its big stake in Tencent. And at the time I made the position, I thought and I still do think that Tencent is undervalued. But then on top of that, Process was trading at a discount to the listed equities. Plus, they had a sizable number of unlisted equities, and so you sort of like get a double discount there. And so I built it in 2022. I only held it for 6 months, and it did become a profitable investment. But I decided to part ways with it because at the time Alphabet was trading below $30. I just pulled it off here. I exited February 27, 2023, and I just felt that Alphabet was a better opportunity, partly because of the catalyst that I didn't see to the same extent as Process. They did have the buyback catalyst, but it wasn't to the extent that I wanted it to be. And I think it was also a reflection of I moved more and more into a framework of high quality companies and looking a bit less at the discount to intrinsic value. I'm just going to do the humble brag and then say since then Alphabet is up 50% and Process is down 30%. But as an investor, you're playing the probability. So if we were to do this like 1,000 times, I certainly wouldn't have the same result all 1,000 times. And please correct me if I'm wrong here, Clay. I think you followed me into the trade because I think I sent you a message on Slack saying, hey, I'm buying Alphabet now. I think it shouldn't be trading lower than like 90%. It should be at least 150 with some upside. And so I don't know. Please correct me if I'm wrong.
Yeah. We went back and forth on Alphabet's valuation, and we looked at the big 4 or 5, 6 pieces they have. Their obviously search business, their cloud, YouTube, a lot of these just really, really incredible businesses. And we both thought it was well undervalued, and the market, happened to work in our favor as it quickly rebounded from that $90 price level, and actually added to Alphabet and Amazon at that time, and ended up scaling out of both of those positions just because I found some opportunities that really just felt pretty confident in the long-term growth runway, and not as much confident in some of these big tech names. And to your point on Process, I've sort of given myself this unwritten rule to never invest based on sum of the parts or discount to intrinsic value. We'll see if I am able to stick through that. There's plenty of ideas running through our mastermind community, and you never know when something super compelling is going to come up that might not align with that quality investing approach. And as you said, there's nothing wrong with investing different from me or investing different from Stig. And again, Chris Mayer just really helped me develop that thinking of, I almost use this filter where, am I comfortable owning this business for the next 10 years? And when you ask yourself that question, do it sum of the parts or discount to intrinsic value play, a lot of times it tends to be like a 2 or 3 year type play where you're hoping it reverts back to intrinsic value. So really focusing on that long term, I think is the advantage I'm trying to use in the markets for me personally, and allocating to these other things. It of course you can make money, but also Stig, you've helped me appreciate the opportunity cost of time as well. It takes time to go through different investments and fully understand them and get to know them well. And even after I own a company, I know it better over time, and that knowledge and that understanding of a company compounds over time, I think. And selfishly, I just don't want to have to research and start that research process all over again once I sell it for a 40% gain or whatnot.
Clay, I think this case study with Alphabet is so so interesting. So the end of January this year, Alphabet was trading at more than $150, and I remember the conversation we had back then. I was thinking to myself, okay, so Alphabet has reached somewhat intrinsic value. At least there might be a small upside to this, but like it was sort of like whenever I bought it at 90, I was like, yeah, perhaps 150, perhaps more. But whenever you have a pendulum, very often like it swings fastest right after it turns. And if I can use that analogy, I've never checked how a pendulum really works, but if it's very much outside of the intrinsic value, you can get a quicker shift back towards that. And I remember thinking at the time, and I still struggle with this. It's not because I know the answer, but to me, Alphabet is just such a high quality company. So the question now becomes: should I still continue to hold on to it, even though it's probably around the intrinsic value? And I think if I found something else, I might have sold Google or Alphabet at the time, invested in that. But at the same time, I'm thinking about this quality framework where you're holding on to a wonderful company like Alphabet that is doing, 20% of return on invested capital or whatnot. So even though it has reached intrinsic value, it's not timing the market, but time in the market. And it's just like, it's not easy, because I know, Clay, and like you're invested in other companies that, like you talked about Dina Polsky here on the show, and a few other investments. Constellation, they just sent out a fantastic, new 10Q, and I'm like, oh, okay, Clay was probably right. He should probably sell just like I did, at whenever I started investing, sell whenever I reach intrinsic value, then move on to the next one. And no, you don't get 100 baggers that way, but then you get a lot of perhaps 50% winners, and then you move on to the next one, and that, if you're good, is another 50% winner, and then you go on to the next one. And so I think the Alphabet case was quite interesting because we discussed it so much, and I got sort of like stuck in my ways with this framework where, as you said, well, it did its job. Now let's move on to something else.
I don't know if you listened to the Bill Ackman interview with Lex Friedman. For everyone out there, I highly recommend it. It was an incredible chat, and they talked about Alphabet, and Ackman, he also added to it probably around the same time we did, around the $90 range, I would guess. And he mentioned that, there was a lot of ChatGPT kind of beat down the narrative on Alphabet because, of course, search could be in the works of being disrupted. Right now, it seems to be pretty stable, if not growing. And Ackman even said that Alphabet might even be in the lead in the AI race. So, yeah, it'll be interesting to see how these big tech players with a lot of money end up taking the direction of AI. There's also going to be a lot of startups that just get bought up by these companies eventually. And I want to mention, if anyone in the audience has a great connection to Bill Ackman, I'd love to chat with him on the show. And I've tried for quite some time, and with no success thus far.
Wonderful. Well, unfortunately I don't, but it's that's a great idea. That would be a fun discussion, Clay.
My next question for you, Stig, is comparing your portfolio to a benchmark. Is this useful? Is it necessary? What are your thoughts?
I generally don't think that benchmarks are useful for private investors. I think they're probably just going to add to your stress more than anything else. I do think that if you're an asset manager and you're taking client money, like if the premise of what you do is you can outperform the S&P 500 or the MSCI All Country World Index, whatever, yes, I think you should be benchmarked, and you should be beating that benchmark to be worth your salt. For example, in my case, I don't think it would make sense to be invested with Paprai funds if I didn't think Mohnish would do better than me, or if he wouldn't do better than MSCI All Country World Index. Like that would be a bit silly, because I could buy global stock index myself and then be done with the hassle. But Of course, if you're an asset manager, there are also different types. If your goal is it's family office and your goal is to preserve capital for the next 5 generations, no, you probably don't want to add that stress of you want to outperform the S&P 500. Perhaps you want to diversify into a lot of different asset classes, and those asset classes are probably not going to outperform the S&P 500, and that's okay, because what you're doing is you want to achieve your financial goal, which is something different. It is with quite some hesitation whenever you asked before, like, which benchmark should I use? And I'm like, I don't really know if I should use any benchmark, but since I'm sort of like, I put on the spot, or I'm putting myself on the spot, I think it makes sense for a global investor to use the MSCI All Country World Index. And another approach could be, you can of course also compare to the S&P 500. I don't necessarily know if that makes sense unless you're a US large cap investor, or if US is your universe. I think it has a different risk profile. I think a lot of people would probably say it has a lower risk profile. I would probably say that it has a higher risk profile, but again, that really depends on where you're coming from. I really like also to look at Ray Dalio's all-weather portfolio. I think the thoughts behind that is very interesting, because he's not only looking at equities, he's also including some bonds, commodities, gold into that. And so I think if your goal is to preserve capital, and you invest in multiple asset classes all over the world, I think that could be an interesting benchmark to look at. But really, it should be all about meeting your financial goals. And for that reason, I don't think benchmarks are that useful.
I'm currently going through The Intelligent Investor, and Jason Zweig added some commentary on this, and there was a brilliant point I read in it where a lot of investors like to think about probability, or like they like to think about the potential upside and the probabilities they think are associated with that upside. But he brilliantly, I believe it was Zweig, brilliantly pointed out we need to also consider the consequences. So if someone runs a highly concentrated fund, they might assign very high probabilities to all these picks, but you have to also consider what are the consequences of being wrong. And I'll be sharing an episode likely in a few weeks I'll dive into this much further. But I just thought that was a brilliant point of not only, investing based on the probabilities, but like, what's going to happen if you're wrong? And, and when you relate that to your point of achieving your financial goals. So for me, if my goal is to achieve financial independence, and I'm like, hey, I found 2 or 3 amazing companies, I'm going to go all in on these 2 or 3 picks. It's like, okay, what's the consequences if I'm wrong? What if the probabilities I assess are wrong? And that's something super interesting that came to mind when you mentioned, looking at your performance, judging it against what your goals are as an investor. And I wanted to transition here to talk about investing in a different light. Many investment podcasts out there have a fund on the back end of what they do. And some people have asked me when we're going to start our own fund, or when we're going to open it up to let people invest with us. And I'm sure many more people have mentioned the same thing to you. And, especially with the track record you just mentioned, I'm sure someone's wondering how they could hand you some money. And I don't think raising money would be an issue, for TIP if that was a direction we ended up deciding we wanted to go. So I'll just open it up to you. Would you ever be open to managing money for others, considering the 20% CAGR you mentioned earlier?
Clay, I occasionally get asked, and so far I've said no, and I don't expect for that to change. And it really comes from a very selfish perspective of happiness. I see a very limited upside from doing that and close to an unlimited downside. which is the exact opposite of what you should do as an investor, of course. And so, okay, so let's talk about the upside of managing money. So I was listening to this interview with Bill Ackman. This was an interview he did with David Rubenstein in his book, How to Invest. And he talked about how much purpose he found in managing money for other people. And, Bill Ackman's net worth is, in the billions of dollars. So it's not like he needs, like, one thing is, like, you need to pay your mortgage so you manage money for other people. That's not the case for Bill Ackman. Like, I don't know his mortgage, but I'm pretty sure he can pay it. And I think it was just it was a beautiful purpose that he wanted to do wonderful things for other people. And I think for us here at TIP, I think we also find a lot of purpose in helping others and empower them and give them the tools to make better investment decisions. And I'm going to make the perhaps unreasonable assumption that most people who like to manage money, they either do it because they need a salary or because they just like the game. And sometimes it's probably a combination. And I think if you want to play the game at the highest level, it's a huge driver for a lot of managers to take in client monies because they can do other things with that. And there's a lot of money in asset management. It's not, I'm not going to be naive here. And if I wanted to make more money, I think that asset management is probably the simplest way to go. I think it would come with a lot of grief, but I think it's probably the simplest way to go. And like, I have no idea how much money I could potentially raise. I don't know, let's say 50 million, 100 million, something like that. And we could probably do a 2 and 20 structure. So 2% in fees and like 20% in profits. And that would be like 7 figures in fees, even in a down year. So the first thing I would say to that is I've had TIP for 10 years, and I've always said that a 2 and 20 structure is ridiculous. So I would be quite the hypocrite to then say, oh, come to my fund, let's do 2 and 20. There's probably good reason to do the 2 and 20 structure in some, I don't know, venture capital, private equity, I don't know. But like for a company that's doing public equities, I can't see why you do 2 and 20. I don't think you're aligning your interests well enough with your shareholders or your clients. So you asked me before, Clay, about Mohnish and why I would invest with him. I think a 0.625 structure makes sense. So it probably would be set up like that. And also that there will, of course, be a lot of money to be made if you want to go that way. And I should probably say that if you asked me like 8 or 10 years ago, I probably have jumped at the chance to manage money. It seemed like a lot of fun. It seemed like you can, I wouldn't have to do my normal day job. I could sit back home and like read financial statements. But I think today I would probably go crazy sitting all day reading 10Ks and 10Qs. I don't think I have the temperament to do it. I'm also going back to my previous statement of I attribute my track record mainly to luck more than anything else. So since you by definition can't count on luck, I would feel bad about managing money for other people because I don't think I can replicate it over the next decade. And then, just from a happiness perspective, we're 25 people here in TIP, empowering team members and listeners. It seems more fun than picking stocks, at least for me. Who knows? And really, like, it comes with so much downside. Whenever you go into that, sometimes I do speak with asset managers about how is it to manage funds, and some people really, really like it, but everyone hates all the red tape around it. Because for good reason, there is a lot of red tape because you're managing other people's money. And the reason why I started TIP was because I didn't want to, ask my boss or whatever for permission to do XYZ. Like, if I want to go to the dentist, I would go to the dentist. And, you're under such a scrutiny all the time by managing money for other people. And then, of course, the biggest drawdown of all of it would be what would happen if I lost money for clients. And I don't know, the more I read about people who manage money for other people, and speak to those people who do that, the less I just want to do it. One example could be something like Bill Miller. He has the biggest stake in Amazon without the last name Bezos. And he talked multiple times about how he just got pestered by his investors since he bought Amazon because it was such a huge part of the portfolio. And Bill Miller kept on saying, I don't want to sell Amazon. It's going to be a great investment. And they said to him, no, it's too big a part of your portfolio. Like, I don't want that stress. And there's probably an irony of, whenever I needed the money, I wanted to manage money. And now that I'm financially independent, I just don't want to manage money because of the stress. And, you and I, Clay, we have this joke that we meet some of the wealthiest people in the world and everyone thinks that they're frugal. Like, seriously, everyone is telling us that they're frugal. And I don't want to give you a spiel of being frugal, but, my wife and I don't have any kids. We don't own a car. We don't pay for healthcare. We have a $1,200 mortgage. Like, it's just like the stress of managing money for other people just seems terrible if you don't need it. So I know that was a very long way of saying no. But I guess to your question, would I like to manage money? I think the short answer is no.
Yeah, it really comes down to if it's not like a screaming yes, then it's probably a no. You can't just want it. You have to really want it. And I mentioned that Ackman interview with Lex Friedman, and man, hearing that interview and just some of Ackman was very public about many of his investments, and there were so many people out there that just wanted to tear him to the ground for whatever reason. Some people did it not even to make money. They just wanted to take him down just because they wanted to. And imagine, going to bed at night not knowing if some billionaire is going to be betting the other side of a position that you've been public about. And that it's just very, very frightening. And I'm not saying that's what would happen if we started a fund here at TIP. And Bill Miller also helped me sort of see it in a different light too. I've revisited William's excerpt in his book, Richer, Wiser, Happier, on Bill Miller. And during the great financial crisis, I'm not sure if many people are aware, but Bill Miller saw his assets under management during that time go down by 99%, from $77 billion down to $800 million. And part of it was because Bill Miller, he bet really big on financial stocks during the crisis. He thought the Fed was going to come, ease markets, but these financials just kept falling and falling. And Bill Miller, he's also well known for being really a stoic when it comes to losing his own money, but he just became a mess when he was losing so much of his clients' money, and he just hated it. And I sort of resonate with this myself because I feel that I can handle a lot of volatility. I see it all the time where these stocks, they go gap down 5%, 10% a day. And it's just for like either random, unknown reasons or some reason that's just ridiculous. Like, it really doesn't bother me too much because I know that when you really compress the time frame, it's really just a lot of noise and it tends to not really matter. But that doesn't mean I would feel the same way if I was investing someone else's money. And a lot of the things I own, I really wouldn't recommend that anyone else owns it. Like, I can't recommend it just because there's a lot of volatility and there's always this uncertainty. Like, what if I'm wrong? Like a lot of these things could probably go down 50% over the next year. And how I know how I might react, and I know how I might assess the situation, but how someone else might react and how someone else might assess that is a totally different ballgame. And also in managing a fund, like Bill Miller saw his AUM go down 99%. Part of that was because the fund itself went down, the assets did, stock prices. But another part is just investors were fleeing, and they needed money. And just to see that investors can just pull the plug on you at any moment, is also very frightening, because if that's your source of income and that's how you make a living and that's really your reputation, like what are people going to think about you if they see your fund's assets go down 90%? Like they're probably not going to look too positively on that. And Bill Miller, he was also forced to fire a lot of employees because of that. He's bringing in substantially less income, and he is publicly shamed in the press, ridiculed on social media. And then, of course, in very Bill Miller fashion, in the decade that followed, he was a top 1% U.S. equity fund over that 10-year period. So he definitely bounced back and sort of redeemed himself. And, reading about stories like this, hearing about what happened to Ackman, it's very humbling. Even someone like Bill Miller, who beat the market for 15 years in a row, can see dark days come eventually, and just look like a total fool in a span of 1 to 2 years. And for those that are interested in reading the whole story, it's in the epilogue of Richer, Wiser, Happier towards the end of the book. And it's just also a good reminder that life is just inherently really hard, and asset management is no exception to that. And all of us are inevitably going to go through these very difficult periods when things aren't black or white. There's a lot of gray we have to sift through, and being humble during the good periods helps us recognize that it probably won't last forever, like it didn't last forever with Bill Miller. And the good times and the bad times are just driven by so many things outside of our control. So I'll throw it over to you if you have any other concluding remarks on that.
I don't think I have too much to add other than Bill Miller that you mentioned. Like he completely changed his setup to be more congruent with the way he lives his life now. And so I do think that still take on clients' money, but it's structured very differently now. So he can more or less do whatever he wants to do. And I kind of find this to be an irony of some very wealthy people who can do what they want to do, but just don't do it. To me, that sounds a bit ironic. And one of the things that William and I talk a lot about off the podcast is like how can we best live a life of subtraction? How can we best take things out of our life? And it's so tempting to set up so many things. Like whenever we have the TIP platform, we can do so many things, and we also do a lot of things. Don't get me wrong, but like, I think managing money, to go back to your point, just falls in the too hard pile. It's just like if you want to live a life of subtraction, that's probably not the road you should go. Even though there's like this almost, I wouldn't say guaranteed pot of gold, because I kind of feel like it sounds wrong, especially if it's a 0.625. But like it's a weird situation you have in if you have a different type of platform and you sort of like get a lot of different opportunities. Like we talk a lot about the best productivity tool you can have is just to say no. And it's so tempting to reach out for that new shiny item, and we should probably say no more often than we do.
One thing I've learned just through experience and observations over the past couple of years is things are always going to change in ways we just can't even imagine. And who knows, 6 months from now, maybe we meet someone who wants to manage a fund with us, and they are the perfect match, and all the stars align, and we end up launching a fund. Who knows? Maybe it will happen, and Stig has a total change of heart in due time, and maybe it never happens. Who knows? And one of those things that has really changed, my role with TIP and what we do here is starting our TIP Mastermind Community. So I was organizing our free events in Omaha for 2023, and we put together 4 events, social hours in Omaha, and we put a sign-up sheet out there, registration form, to get an idea of who's interested. And within weeks, it was just like crazy how many people wanted to meet up with us in Omaha. And really that sparked the idea of starting our TIP Mastermind Community, because we realized that people really want to network with other like-minded people. And it's just been such an amazing journey of meeting so many incredible people. Earlier, I mentioned meeting that member who worked with Bill Gates, Steve Ballmer at Microsoft for 25 years, and on our call yesterday, he's just like, he worked his butt off essentially for 25 years straight, and he just had to unwind for a bit and retire and just sort of unwind from all those experiences and all that work he put in over the years. And it seemed to certainly pay off well for him. But, that's just one example of so many people I've met through starting the community. And I actually, I hop on a call with each member to get to know the type of people that are joining, what they're looking to get out of the group, to ensure that we make sure that we're a good fit for each other. We want members to come and, get a lot of value and join for the right reasons, essentially. And Stig, over the past year, we've talked quite a bit about what's been going on in the community. We had a live event in New York City in October of last year, and where you have our next set of social events in Omaha here in May during the Berkshire weekend, specifically for our TIP Mastermind community. I was curious if you could talk more about your role with the community and some things you'd like to work on going forward with them.
So I'm probably terribly biased whenever I say this, but I absolutely love the Mastermind community. It's so nice to have a chance to build relationships with people and do it in a different format. And so one of the challenges that I felt that I had, building the podcast together with Preston, was that most of the interaction came through email. So there was a very one-on-one thing. And, I tried Twitter, sort of like to mitigate that and create more value and reach more people. And I just found it so toxic to, the way that people communicate, or some people communicate on Twitter, that I had to stop it. And I also think that there is actually, even before we had our Mastermind community, even before we had TIP, Preston and I had something we call Buffett's Books. I think it still exists, but I don't think the community exists. Or it was a forum. It looked something like the 90s, and it was programmed in HTML. And but it was a lot of fun, sort of to start building relationships. That was how Preston and I, got to know each other in the first place. But it was also challenging because you didn't really. It was just a screen name that you were interacting with. This was a time when people used something called Skype. So to our newer listeners, they would think of it as old-fashioned Zoom. It was an interesting forum, but also I felt we wasted a lot of time because anyone can sign up. It was completely free, and people would go in and say, "How can I be rich?" ? And you would go I don't really know how to, I don't know where to start from here. And so one of the things that we wanted to do, because we had so many interesting conversations whenever we were doing our live events with TIP, was can we create what we do now in Omaha or wherever that might be? Can we do that in a global format, an online format, so we have access to each other all the time, and not just once a year in Omaha? Because another thing that I also find, I don't know if frustrating is the right word, but there's 40,000 people. There's just so many people, and I get a little overwhelmed. And I'm sort of the kind of guy who's okay standing, in the corner of the room with my phone and just be all by myself. And so for me, it's not the right forum in a way for me to go to Berkshire, because I just get so overwhelmed. And so I kind of like the idea of having an online place to chat. So whenever I feel, I have the energy and I have the time, I can interact with members. And it's very often the same people. Right now we are around 100-ish people, and we want to cap it 150. So you do get to know people. And because we also don't live in the age of Skype anymore, we actually have calls on a weekly basis, sometimes multiple times a week. And so we can interact just like a normal call with a video call with people, which which is a lot of fun. And, you can talk about stock investing or life or whatnot. And so the next call, for example, that I have scheduled is that I'm going to interview Mohnish April 1st. And so this will probably be around the time this being published. A few days before, I'm going to meet up with the Mastermind Community. And I'm giving myself the mission to go through all of Mohnish's content from last year until now. I just calculated it today, or counted, it's 50 videos. And so I'm going to go through that 50-ish hours of content in the next 3-ish weeks. And I'm asking everyone to join me. It's not like you have to go through 50 hours of content to jump on the call. And then I'm going to selflessly ask the community if they have any questions that I can ask Mohnish, but also talk about what can we learn from him? What can we learn from each other? So that was one call. The last call I did was interviewed Christian Billinger. You interviewed him on episode 582. And we talked about MS and LVMH. And because we have a bit of a different format in the Mastermind Community, where we also have, we can do video, which we can't do on the podcast for obvious reason. We analyzed the balance sheet together, which is very difficult to do on the podcast, whenever it's pure audio format. So Christian was very, very kind, and he broke down the balance sheet and what do they invest in and why do they invest in. So you can sort of be a bit more nitty gritty in some topics because of the video format. So I don't really know if I actually answered your question, Clay, but as people can hopefully tell, I'm very excited about the Mastermind Community.
Yeah, so I also booked a couple events I'm really looking forward to with the community. One of which is I like to try and find members that are especially work in the investment industry or just manage their portfolios full time, and it just signals that they're taking this endeavor of investing very, very seriously. And what I really just call it is just talking new stock ideas, and it's like a round table. So I asked 4 or 5 people that I know are super serious investors. I asked them to come in and just bring one idea and just kind of paint a bit of a picture around why they like it. And a lot of people like to do that. It's a really big ask to ask someone to, put together his whole pitch or put together a presentation. We do have people do that. People share ideas in a one-pager format, or some members even do a whole hour-and-a-half long presentation. But it's a lot easier to ask people hey, are you free at this time? And are you open to sharing an idea? And, that's pretty easy for people to do, and they love it. And, it attracts a lot of attention. We'll have 5 people join, they have an idea, and then there's 15 others in the community that join it as well, and have some contributions to the discussion. And you never know who in the group is going to be knowledgeable about the idea you end up sharing. So I find that quite interesting. And I also booked a YouTube interview with Brett Kelly, founder and CEO of Kelly Partners Group. And he was kind enough to also do a Q&A with our community. And that Q&A is scheduled for the first Tuesday of April. I think it's April 2nd at 5 p.m. Eastern time. So really looking forward to that one as well. And it should be a lot of fun. One difficulty that's been sort of impossible for us to work around is the time zone issues. When I say 5 p.m. Eastern, it's, call it midnight-ish for you for the Q&A with Brett Kelly. And what we really try and do is just kind of mix it up. Like Stig does a lot of his calls in the afternoon Europe time, and then I mix it up and do some of my calls in the morning U.S. time or afternoon U.S. time. All right, so before we close it out here, I also wanted to mention that we're also hosting what we call the Berkshire Summit in Omaha. This is a higher ticket event for those that really want to make the most of their time in Omaha. And I'll be in charge of organizing a couple of very special dinners we'll be having. One is on Friday evening during the Berkshire weekend, May 3rd, and then another dinner on May 4th on that Saturday. And William Green and myself have invited several special guests for the dinners, a couple We Study Billionaires guests for Friday, and then William invited a number of his guests from the Richer, Wiser, Happier show for Saturday. And we have some other very special things planned. And we only have 2 seats available. So if you're interested in checking that out, I'll make sure that's linked in the show notes, or you can just simply email me, clay@theinvestorspodcast.com. we'd love to have you join us. And Stig, thanks so much for joining me today. It's always fun chatting with you on the show, and always learn plenty of new things, and I'm sure the audience does as well.
Thank you so much for having me, Clay.
So the key in investing is to recognize two things. One, we're going to make a lot of mistakes. Two, this is a very forgiving business. You can be wrong even 98% of the time, still come out smelling really nice. And three, that is only going to happen if you are able to buy businesses with great economics at reasonable valuations and then hang on to them forever. So when they get fully priced, they don't get sold. When they get overpriced, they don't get sold.